I don't have the time to start a business, so the next best thing for me is really investing in the stock market.
After I bought it, the stock kept going down for the next 2 years.
As you win, you become more cocky, arrogant.
During the Lehman crisis, everything collapsed.
Geopolitical talk is all very entertaining, but predictive value is very, very low.
It's like any sport, you're down in this set, what do?
Fear will kick in.
Whenever I look at Moonshot, if it can add values to society and we need it, I will personally think that there's an opportunity to grow that level.
There's a lot of resource out there for you to screen. You need to find that winner.
Hello. Welcome to a special episode of Kopi with Uncle Songs and Friend. Today's setup is very different from prior episode because we are having an event here talking about investment, about strategy or investment. How do we invest in this more difficult, challenging environment? And clearly about the psychology, the emotion, the strategy that is needed to cope with this kind of volatile environment. And with me will be a couple of very seasoned veteran so fund managers, investor as well, and students who are starting out on their investment journey. It should be a very interesting little discussion tonight. Are you all ready? Come, let's follow me. So, to get the ball rolling, I'll start clearly with something very straightforward in terms of long journey. Obviously, Ming over here, Malcolm along the way as well. We start with a low point, bad mistake, worst mistake you make so far in your journey. What do you learn from that, and how do you bounce back? Low point, and then we slowly go up into the outlook as well. Ming Sang?
Hi, I'm Ming San. So I've been in investing for a long time, both on the sell side as a broker as well as on the buy side as a fund manager, and also with the National University of Singapore with their very long-term endowment fund. I started talking to a few of you outside there that investing is a game in a sense. A game in the sense that there's an objective, there's a set of rules, right? The overall objective, of course, is to put money out today, and hopefully in the future it will be worth a lot more. Of course, what is the future? What is your target rate return? There are many games you can play within this idea of investing. You can play stock markets, you can play private credit, you can play property. You can play it on a short-term basis, like tomorrow, next week, next month. You can play it on a long-term basis, 1 year, 3 years, 5 years from now. And don't force yourself to, or rather you can, if you want to try these various games and see whether they suit you, whether you think it's easy to make money. And then eventually decide which is the game that you want to play, and be very clear about that, because if you try and play a game that you are not good at or that is too difficult, then it will be a struggle, and it will be very difficult to succeed. I think many of you would have participated in the investment challenge organized by CGS. So it is a game. It's a stylized game in the sense there's a set of rules, there's an investment period, there is a certain amount of money to start off with, and how much you can gear up. Share with you my own bias, which is to say that short-term trading is a very difficult game to play because it's about predicting tomorrow's markets, whereas long-term investing is about trying to determine which companies will be worth a lot more in the long term, over the long run. And that's a game that many more people can play. I think it doesn't matter whether you're a housewife or a teacher or a doctor or whatever. Long-term investing and saving up is a game that will pay off, but you need a bit of discipline to go and do that.
In terms of bad investment that you have rebounded from as well.
So I'm Malcolm.
Yeah.
I mean, just to share with you, mistakes that we all make in life. I think just to give you a bit of background, I had the privilege of having Ming San as my boss. For more than 10 years, when I first started out in my career. He also took a lot of effort to teach me how to look at the markets, right? How to be a better investor. I remember the first stock that I bought. Anyone know what is the name of Capital Land before it was Capital Land?
I'm old enough to answer that.
Yeah.
It was
So the name before that was actually DBS Land. So I remember, as a 18, 19-year-old, first time trading, I opened a trading account. I read some research report So I was very diligent. I picked a research report that I think is credible. So I said, oh, this is from Goldman Sachs, reputable bank, right? I said, hey, DBS Land. It says that it has a RNAV of, let's say, $5. And it's trading at 40% discount to RNAV. I said, that's not bad. A revalued basis on all its properties is $5. Now I'm buying at 40% discount. So I said, oh, that's very cheap, right? Good discount, right? So that was my first purchase. After I bought it, the stock kept going down for the next 2 years. The RNAV also went down, but the 40% discount still stays. So that basically is my starting point, right? Again, that taught me how to be a better investor. Then I started that time I was still in army. I started to read a lot more. How does this game really work? Like if Ming mentioned again. So even the materials that you consume out there, written by professionals, at the end of the day, you must know what you're buying. Like whether you are good at technicals, whether you're good at fundamentals, you must know what you're buying. Because you need to know why are you winning. If you don't know why are you winning or why are you losing, then you have lost the plot. Because it's just a one-off. But again, if it's a one-off, then the question is, the next bet that you're going to make, what size are you going to do? So it's no different from gambling really. Because are you going to put all in? If you're just guessing, if you put all in, at some juncture you lose everything. Because you're not sure why are you winning. You're also not sure why are you losing. When you read something, right, you need to fully understand what are you reading. Because prices do move. So whatever valuations that you see out there, whatever forecast that you see out there is moving every day, every time. And you have to basically challenge the assumptions. And that's why the course that you've been through, those are basically foundations for you to challenge other people's assumptions. Because at the end of the day, if you have a target price in mind, you're going to exit at this price. You need to know why is that your target price. You can be wrong, right? But when you are wrong, you refine, right? You refine your understanding. So you got to know why you are winning. You got to know why you are losing. I think that's fundamentally more important.
True. So Billy, along that line, is there some stocks that you may have held on for too long, or you cut before it turned around? Or what's your own personal sort of a learning journey so far in that space?
So I think my starting point in investing was a bit more lucky because I started off at a very good path. So when I started off, I took my scholarship money and I invested in a lot of the consumer stocks in Malaysia. And at that time, it was doing pretty well. So, but as you win, you become more cocky, arrogant, right? So that's when things happen. But after I graduated, I worked with Great Eastern. So I was their scholar. So I actually transferred to the investment department, and then I learned a bit more about the stocks and all that fundamentals and things like that. So then back then there was this talks about the oil and gas industry being, it was around 2014 before the crash, before the collapse because of the shale oil at that point of time. So I was looking at some of the research report, and stocks did, in terms of fundamental valuation, it seems to be pretty good. Made a decision to take a bit more risk, which I have not done prior to that, which is to invest in small caps, the smaller or mid or penny stocks, let's put it this way. So there's this counter called Hubline in Malaysia, which I bought. And at that point of time, prior to that, it spiked up about 50%. I mean, actually, I buy it before it spiked up. But I was still holding to it because there was talk of it will continue to go up and stuff.
150%.
No, only 50. But then the problem was that you become greedy, and that's the issue with me at that point of time. And I was a bit overconfident on how I stock pick. It's like, I think I like, everything that I choose will go up. But it doesn't last, so the price actually came down, collapsing. So and it doesn't worth much. And I eventually, when I sold off, I lost almost everything that I put in. Although I did not put in a lot in that particular counter. But what I learned is that greed is one. Secondly is that you try not to be overconfident in what you're thinking of. So I think that's really the most painful lesson that I have in my investment journey.
These days, I suppose it's far easier to do research than when we started out with typewriter. How would we approach such stocks when, either way, either it came down or looks more attractive? Now, instead of $1, it's now 70 cents versus instead of $1, it's 130.
I'm going to share you this. I think Ming San probably shared this with me 20 years back. I'm not sure if he remembers, but I think it's still relevant. If you have a fresh dollar to deploy, right, you don't look at the concept of averaging down on a position that you lost money. You have a few thousand stocks out there to buy. You should be looking at that juncture, if markets comes down, right, this dollar to deploy based on what you want to achieve. Let's say you want to achieve a 50% return, right, 60% return. It depends on your risk tolerance. Where is this dollar best deployed? Because whatever that happened to your current position is water under the bridge. The question is, where are you going to deploy this dollar? Because if you're so myopic to keep looking at averaging down, you may have missed a few thousand opportunities, right, that have corrected, significantly. There's a better value than this position. During the Lehman crisis, everything collapsed. Very, very competitive fund managers, what will they do? Right? Very, very competitive fund managers, what they would do is they would look at their whole portfolio and recycle the capital to better quality names, better valuations. Because what they want to catch is the rebound. It's never the concept of averaging down. Because you look at on a relative basis, what's available in the market, which one has better value. So I remember even from my own perspective, even I have my own investments that my portfolio was down during the crisis. I'm very competitive, right, in nature, including investing. When the crisis came, I liquidated everything. I think I had like 20 over names. I liquidated everything. Then I did my research. I like one particular stock in Indonesia that has collapsed 90%. It's limit down every day, 90%. But it has a very nice resource base. Balance sheet was okay, they can ride it through. But it was just situational. So I sold everything I have. I put everything in one position. I can be very wrong. Then from there, it's still limit down every day. It's down, down, down for about maybe another 5-6 days. But that turned out to be probably my best investment because on a rebound, it went from like 350 rupiah. It went all the way up to about 2,500 rupiah, right, in 1.5 years from there. But again, that basically is important because if you always think about averaging down, I have 20 positions to average down, but I wouldn't have caught that rebound to recycle into a better quality, better valuation.
So this also comes back to the psychology of investment, being able to keep control of your emotion, your psychology, to be able to look at the situation and then sort of look at it in a cold, factual manner that this is not the end of the world. We'll come back. We have come back before. And then I suppose this is where it was. To what extent
it's like any sport. It's like any sport. You're down in this set. What do? Right? You want to win, right? So you want to win, you got to really... You can screen a few thousand stocks nowadays. Because, there's a lot of resource out there for you to screen a few thousand stocks. You need to find that winner. So you need to be competitive enough to know, if you're down, how do you bounce back harder?
In that sense, comes back to the emotion. So how do we, or as a person, sort of keep and balance that emotion, or whether it's fear of missing out? Good example like current market, for instance, as well. We have seen worries about tariff, about slowdown, about slower hiring, but markets continue to crack new highs.
Yeah. As Malcolm points out, emotions is a very, very big part of investing, and knowing yourself, knowing your own cognitive biases, maybe this is how you distort your own thinking or whatever. If you can be like, Spock in Star Trek and be able to detach yourself completely, that is good. And I know some very good investors who are completely detached from how they trade and invest. Most of us are more human, we can't do that. But one of the ways to do it is to they say, plan your trades and trade your plan. In other words, pre-commit and say that, okay, I like this stock, I've done my analysis, I think it's worth $1, I will buy it at 80 cents, and then you write it down, and if it hits 80 cents, then you kick your plan into action because you've really pre-committed. Don't when it reach 80 then get second thoughts or say, maybe I wait for it to go to 75 or 70 or whatever. So pre-commit, and especially during times of crisis, I know when the time comes, I will not have the, how shall I say, fear will kick in. So to avoid that coming in, I will say, okay, this crisis is going to last 12 months. During those 12 months, prices will go from 100 down to 40, a 60% drop. So I say, okay, I will commit 10% at 90, commit 10% at 80, commit 20% at 70, commit 30% at 60, and just pre-committed his trades. Otherwise, you miss the train on the way down, you miss the train on the way up.
I suppose to what extent then, coming to today's investing world, the use of AI would help remove the emotion and psychology? Do you think that will happen?
So obviously, in the trading world, right? All these top quant traders, the Renaissance technologies of this world, have used machine learning for a very long time now to optimize their trades and optimize their portfolios. But in a sense, that is playing a kind of a well-defined closed loop game, like playing chess or playing Go, right? This is the board, these are the rules, these are the stocks you can buy, the 5,000 stocks you can buy, whatever, and then just using AI for that. I will set that aside. Where I'm seeing now since the advent of ChatGPT, and this is very much a post-ChatGPT, post-Gen AI thing, is that a number of investment committees I know are now taking all their old investment proposals, all their board minutes, all their results, feeding it into AI, feeding in the results, and then they are using it to not so much to tell people what to do, but to create a virtual investment committee member. That investment committee member, who is completely virtual, a Gen AI creation, will sit there and ask questions or probe the investment discussion and investment decision. Personal relations come into it. He's sensitive. I don't want to offend him by telling him, his idea is stupid, right? But if Gen AI can say it, then it's not personal, right? So that's coming in now.
I can't think of a better way to grow my wealth aside from starting a business. But I don't have the time to start a business, so the next best thing for me is really investing in the stock market. That's how I get started when I was at 19. But I realized this thing, that whatever idea that is called this Moonshot, whatever, for example, AI, everyone is talking about it today, is about how it's going to add values to it, right? One of the things I'm going to talk about is, I'm going to mention a bit on crypto that I missed out on, and I still have no idea how well it will go. Is because the reason is simple, because I don't really know how crypto can add values to our society, as in the adoption rate of it and all that. So it's very hard for me to figure that out at this point. Even before we talk about AI, I always taught this in all the sessions that I have. I always bring Microsoft as an example, because I always believe in management. The track record is very important. The reason was because the shift towards cloud at that point of time. And back then it was not as sexy as today. I know today is a very sexy business, everyone talks about it. But back then Microsoft was struggling, because year in, year out, Apple is taking the shine out of it. But I was talking about it, and a lot of people think that, you're talking about a company that is on the downtrend, right? The way I see it is the sort of values that the company adds. So in the case of Microsoft, the values that they add is because, look, almost all businesses, their business-to-business model is very strong. A lot of businesses use Microsoft, whether it's their cloud service or their software as a service. And during the CrowdStrike, when there was the virus attack, a lot of airline was down and all that, because a lot of them use the same software. So it shows the sort of implication. So whenever I look at Moonshot or whatever good ideas that we have, I always look at what sort of values that the company is going to add in, right? If that investment, or that whether it is a company, whether it's crypto, whatever asset classes, if it can add values to society and we need it, I will personally think that there's an opportunity to grow that level. So that's how I really look at opportunities in the longer term. So I mean, of course, I do look at it on yearly basis and stuff like that. But I always believe that if we want to talk about things that is going to shoot to the moon and stuff like that, there must be a value that it adds onto our daily lives.
There's a game you can play, right? Today is 2025, and if you imagine, go back to June 2020 and ask yourself what the world will be like in 5 years' time. You had no clue that the world will be what it is today. You go back to 2015 and predict the world in 2020, you had no clue that we'll be in the middle of a pandemic. Geopolitical talk is all very entertaining, but predictive value is very, very low. If you believe that our societies will continue functioning in a reasonable manner that allows wealth creation, economies to grow, And with technology and all these things, there's no reason why the world or Singapore and the world in 5 or 10 years from now would not be a lot more rich, a lot more dynamic. Then don't worry too much. And especially for people of your age, I mentioned to some of you earlier on, the important thing about savings is starting early and giving yourself time to compound. Don't start late. But as soon as you start working, whether it's $100 a month, $100 a week, whatever you can put away, just put away. So if that's not a game that you can play, then buy ETFs and like the gentleman suggested, that buy ETFs and just put it away. Long-term saving is the way to go.
I think the encouragement for all of you is, if you very, very keen in investing, you're really keen on making money, I mean, that's why you're all here, right? I think you have to put in the effort, you got to put in the hours of getting the skill to do it. But getting the skill to do it is a good thing. Now there's internet, there's a lot of material you can consume. Pick and choose the area that you feel that you can do best. Some of you are better at numbers, some of you get better at programming, some of you are better at accounting. There's no one style fits all, right? But you have to be very eccentric about that particular skill set, above and beyond. I mean, even within our firm, we have traders trading $30 million a day, right? They are very successful in doing it. That's because they are eccentric. They're really so passionate about the subject matter that they can. So there's an encouragement to all of you that it can be done, right? But you need to be very, very passionate. It cannot be a part-time, or I go and look at a few charts, I pay a few $1,000s for this guy 10 lessons. No, it doesn't work that way. It's just pure effort. So remember, effortless is a myth.
Personally, if I were you, I would say start investing today. Even if you only have $100, whatever that you have, I would say start with fractional shares, because then I'm not asking you to do that because I want to promote up. I'm asking you to do that because I want you to get a habit of investing, right? Get a taste of how it feels to invest, that risk. Then from then, grow and learn. So through the fractional shares, through ETFs and all that, you get a taste of it. That this will help you to get started.
So, round of applause for everybody. Thank you, everyone. Thank you for joining me on this special episode of Kopi with Uncle Songs and Friend. Sadly, this is the last episode. This may be the last episode, but certainly this is not the last you'll see of me. Next time, if you were to see me, come up. We have our own little copy, and then we'll chat further from there. So until the next time, ciao.